All right. Hello, everyone. Afternoon to everyone here on the East Coast, and to everyone else, especially our friends over on the West Coast, a hearty good morning. We really appreciate you all taking the time out of your day to join us. My name is Anshul Sharma. I'm the Chief Investment Officer here at Savvy Wealth, and I will be your host for today's Savvy's second quarter investment webinar. Now, what I want to do today is to keep things pretty simple and to keep things pretty practical. There's obviously a lot that's been going on in the markets: geopolitics, inflation, rates, AI software. And I think it's easy to get caught up. It's easy to get lost in the headlines. Now, if we're successful today with our timing, what that means is that I'll be able to get you all in and out of here in about 45 minutes time so that you can go about the rest of your day. But you'll be armed with some additional information and some additional knowledge about what's going on in the markets and what the implications are for investment portfolios. So there's a lot to cover. And so in the interest of time, let's get right to it. Oh, one quick note. Questions. We're going to be leaving about, say, 10 minutes or so for questions. So please feel free to save them to the end. We'll do our best to get them answered. Okay, let's start with the backdrop in really simple terms. Now, volatility has spiked. It was already picking up as the year started from near historic lows. And by the way, the geopolitical risk was building gradually. If you wind the clocks back, we had Venezuela a little earlier in the year. And I think the markets largely shrugged that off. But then shortly thereafter, we saw a much more meaningful escalation here with Iran. And I think that's when things really started to move. Energy prices moved higher pretty quickly. And I think that kicked off a chain reaction of sorts. That was a bit jarring in the moment, but it made a lot of sense when you kind of took a step back. Higher energy fed into higher yields, so the yield curve spiked, both the 2-year as well as the 10-year, and that put pressure on both stocks and bonds. And at the same time, expectations for Fed rate cuts got pushed out as inflation risks started to reemerge. The thing is, and I think this is important, equities didn't really break. They were volatile, absolutely. And if you look on the chart on the right-hand side of this slide here, what we've done here is we've simply plotted the VIX, which is a fear gauge for the equity markets, going back to early 2025. And what you see here is on the right-hand side, that's the VIX spike because of Iran. A little bit earlier on, towards the left-hand side of the slide, you'll see that the rather large spike, and that corresponds with the tariff tantrum from early 2025. So equities didn't really break. They remained pretty resilient, all things considered. And underneath the surface, we actually saw a bit of improving breath. More on that in a couple of minutes. So again, this felt like a shock. Certainly was jarring, but it wasn't a full-fledged breakdown by any sort. Now, I think you can see here on this slide that you can see pretty clearly how markets behaved. On the left-hand side, we've got two charts. Left-hand side are equity markets. Right-hand side are cross assets, bonds, gold, etc., oil as well. And on the left-hand side, you can see almost everything went down at first, but then everything came back up together. And that's not typically what you see if markets are worried about a recession or if markets are worried about a structural break. In, say, a more traditional stressed period, say something like the GFC, what you tend to see is divergence. You tend to see equities fall, treasuries rally as a hedge. And I think that reflects a broader principle here, which is when growth is the problem, usually it's bonds that hedge equities. When inflation is the problem, both sides of the portfolio can come under pressure. And that's exactly what we saw earlier on in March. And so stocks, bonds, even gold, if you remember, they all moved down together and then they all snapped back. The reality was that there really wasn't anywhere to hide on the way down. But importantly, if you didn't make any significant changes to your plan, to your portfolio, you fully participated in the recovery and the rally on the way back up. So what does that signal? To us, to me, it suggests that markets are kind of seeing through this temporary shock, not as a lasting disruption. Now, if you zoom out a little bit beyond just equities and fixed income, I think the market's really balancing four different things right now. First is corporate earnings. Um, the backdrop here is still pretty constructive. If companies deliver on consensus estimates, what that means is that this would mark the sixth consecutive quarter of double-digit year-on-year growth at the corporate earnings level. The second thing that they're balancing, and the market's balancing here, is the consumer. And here it's a little bit more mixed, right? Payroll growth has been softer and a bit more volatile. If you look at non-farm payrolls in January, they were up quite a bit. February was negative. March was strong again. So they've been kind of all over the place. But suffice it to say that the unemployment rates hovering still near all-time lows, it's still pretty solid. Yes, we're in this, let's call it no hire, no fire environment. But all things considered, when you're looking at credit card information, when you're looking at employment numbers, the consumer is still hanging in there, despite the fact that energy costs are comprising a much larger share of their wallet, 16% year on year to be exact, than they did in the past. I think there's two other underlying factors here that are, let's call it maybe adding some friction to the markets. The first is inflation. We're seeing reaccelerating inflation. This is largely due to energy. Much has been written about this in the markets in the headlines, so no need to really belabor that. We'll get into that actually in some more detail in a bit. And the last thing here is geopolitics, and obviously this is related to inflation. This is really the catalyst here behind everything that you see. So you've got two things that are supporting the markets and two things that are clearly creating friction as well. And I think that's why the markets feel a bit, maybe let's call it in between right now. So what's the potential impact on this? And I think this is where the story becomes pretty important for portfolios. Energy. Energy to me is really the bridge right now between geopolitics and the markets. Now, when oil moves higher, it feeds directly into inflation, which tends to tighten financial conditions. And what it does is ultimately it makes the job of the Fed much more complicated, right? It certainly complicates their ability to cut rates, at a very high level. From there, what happens is that that flows into the consumer, into growth, and ultimately into the markets. Now, the important thing here is the following. History tells us that events like these tend not to have a lasting impact on the broader markets. And that's this table on the right-hand side of this document. What this analysis shows is that if you go back through time and you plot 40 plus different events that are similar in spirit to the Iran escalation, so different wars, terrorist attacks, the global financial crisis, if you look across all of these past geopolitical events, about 2/3 of the time, markets are higher 3 months out, 6 months out, and 12 months later. So yes, there is a risk that if this persists, it could affect markets in the long term. But what history tells us is that markets tend to look through these events over time. And I think that's what we're seeing right now. Equity markets fell peak to trough about, say, 8% or so, top to bottom, and then they rebounded about 12% as a result. So markets, at least for the time being, are saying to themselves, this is a temporary dislocation. They're already looking beyond, into what happens when this ends. So here's how I'm kind of thinking about it. Here's how we're thinking about it, I should say. And instead of reacting to the headlines, because candidly, there's no shortage of those headlines today, what we're really asking ourselves is, do we see this being a durable change in the variables that actually drive portfolio outcomes? Because to me, that's what really matters here. I kind of think about it as like this chain moving across the slide from left to right. Begins with energy, goes to inflation, then into policy, financial conditions, and then ultimately into portfolios. And again, historically, geopolitical events like these tend to create a lot of volatility, a lot of up and down. That's what we've experienced. It's a bit unsettling. It's a bit more unsettling to us because today, because we have been in a historically low volatility environment. But it doesn't really lead to this more lasting structural change unless one of those links is really broken. So let's spend a minute talking about inflation, because I think this is, there are a couple of clarifying points here that we want to make. I think one important point on inflation here is that if you look at the two different types of inflation that we measure, there's core inflation and there's headline inflation. And there's an important distinction between the two. We've plotted it on the right-hand side. Headline inflation incorporates volatile assets or volatile components like food and energy, whereas core inflation does not. Now let's take kind of stock of where we are today. Gasoline prices are sitting at, say, a little above $4 a gallon. Diesel is sitting at mid fives or so. Put this into perspective. Recent highs, when I say recent, say 10 years or so, 15 years, occurred in June 2022, shortly after COVID. Gas was sitting up at around $5. Diesel was just shy of 6. Now, gasoline is what most people feel directly, right? We all feel that. We all see it every single day of the week. But diesel is actually the more important piece from a macro perspective, right? Diesel powers trucking, diesel powers shipping, diesel powers manufacturing. It's embedded in the cost of moving goods throughout the economy. So when diesel moves higher, these costs eventually show up more broadly. Now, headline inflation, as I mentioned, includes energy. Core inflation does not, but headline inflation can still work its way into core through goods and services over time. Think about it this way. Headline inflation is coming in at 3.3% right now. There's the last print. Core inflation was coming in at 2.6%. 3.3%, the lion's share of that increase was due to gasoline and to energy. Now, let's just say that this persists for a bit. Well, we know that that's going to begin to flow into core CPI as well. It's going to flow in through the other components, through goods and services. So headline inflation tends to move fast, right? That's that volatile component that's reported out on the news. Core can follow with a lag, especially if this escalation continues for much longer. Now, the Fed tends to focus more on core. They actually have a different measure that they use. It's PCE. Now, it's running a little bit lower and better reflects how consumers adjust their behavior. But suffice it to say, headline risks or the risks to headline inflation can very quickly flow into core inflation if some of these things don't get resolved within the near future. Let's talk about the Fed and Fed expectations, right? Because this is that next part in the chain that we discussed. You can see here the shift is pretty clear in terms of what the market is expecting from a policy perspective, a monetary policy perspective, that is. We went from roughly 50-50 probability before the escalation of a single rate cut in June to down to 2%. So basically 50% down to zero. And this is data that we get from the CME FedWatch. It's updated quite frequently. It does change, and it does change pretty quickly, but this reflects today's thinking. Now, if you fast forward to the end of the year, what's the market expecting? I think it was maybe a 20% chance of one cut. This is markedly different than what the market expected from the Fed coming into the year, where the market expected 2 to 3 cuts in some cases. So in a short period of time, what happened? Expectations moved from easing to a much more cautious stance, a much more cautious Fed. And that was reflected in rates as well. The 10-year Treasury is sitting at around 4.3% today. Volatility's picked up in the 10-year Treasury. Volatility's picked up in interest rates in general. And financial conditions have tightened as well as a result. And this is without the Fed having done anything at all. And I think that repricing here has been the main driver of the volatility in the markets today. So if you pull all of this together, this is a slide to us. This is kind of like our macro dashboard. This is meant to give us and you on the call today a snapshot of where we are with respect to a number of different macro factors. And let's talk about inflation. It's elevated. It's a big driver recently, or a big driver of that increase has been energy. March CPI came in at plus 0.9% month over month. That's about 3% increase year on year. Labor and consumer, things still look relatively stable. Payroll growth has slowed a bit. That's absolutely true, but unemployment is still pretty low, all things considered, sitting in the low 4% range. And spending is holding up, as I mentioned before. So all things considered, the consumer is still hanging in there. The cushion might be narrowing. The employment picture is a little muddy, but I would put this as kind of it's not a detractor, but it's not a particularly strong contributor to things either today. On the right-hand side, this is what we're really focusing on today. I think earnings here are really the counterbalance. We're looking at roughly 12 to 13% earnings growth year on year in the first quarter, which I think if that comes to fruition, that's going to mark yet another quarter of double-digit growth, as I mentioned before. Bottom left, interest rates. I think this remains a key swing factor. 10-year sitting at around 4.3, and as we mentioned, rate volatility has increased. We use a move index to help us track that. It's sitting at 74.4, which is pretty volatile. And I think one of the reasons it's not appreciated as much, one of the reasons why we pay attention to this, excuse me, it's not just the level of rates. It's that it makes the valuations in both equity markets as well as fixed income markets less stable, right? When rates move around a lot, it becomes a lot harder for markets to price risk, and that creates volatility, a lot of it, potentially across both stocks and bonds. Okay, middle box, middle box in the bottom, credit. So on the credit side, spreads are still relatively tight, sitting at around 300 basis points. Put this in perspective. Normally, we would expect this number to be around 4 to 500 basis points. So we're not seeing broad stress. It might be episodic, but it does come in quite substantially and quite rapidly as well. So there's not much cushion there, but they're not getting to a point where we're that concerned of overall fiscal conditions. And policy has shifted, pretty meaningfully without the Fed having to do much here. So the takeaway is this, at least in my mind: fundamentals are holding up. The macro backdrop, to me, is creating a bit more friction. This is an environment that's, let's put it, not breaking. It's bending. It's more balanced and it's more sensitive. Okay, let's spend a couple of minutes talking about earnings. So if you take a step back and you ask why markets haven't broken, I think this is a big part of the answer here. Corporate earnings remain really, really strong. Like I mentioned before, we're looking at between 12 to 13% earnings growth by consensus in Q1. Companies are beginning to report. Over 80% of the companies that have reported, although it's not that huge of a number. I think it's maybe 20% of companies have reported, maybe 30 at this point, maybe beyond that. But the lion's share of those companies have beaten estimates, right? So companies are, at their heart, continuing to execute. Margins are also holding up really, really well, sitting at around 13% for the S&P 500, which is above the long-term average for the index. And then last but not least here, something that's not talked about that much or as much are stock buybacks. We're on pace for roughly $1 trillion in stock buybacks this year. I think that's going to continue to support the overall market as well. There is one nuance here, and plenty of work has gone into this, and that's valuations. So valuations are not cheap. On a trailing 12-month basis, market sitting at, say, maybe 25 to 26, I think maybe 27 in some areas. Forward-looking is a lot more reasonable, sitting at right around 21 or so. But again, the broader equity risk premium, which basically measures the earnings yield on equities compared to the 10-year treasury, there's not much wiggle room right there. So it's another way of saying that equities, in a way, at a very, very high level, are priced not to perfection, but close to it. So we're going to continue to monitor earnings. So far companies are delivering, and that's really great. Upside surprises are up a bit as well. So you've got the macro environment that's creating friction, but earnings, to me and to us here at Savvy, are still providing the foundation. Okay, so with all that said, let's spend a couple of minutes talking about, I think I've got maybe 10, 15 minutes left. Let's spend the remainder of the time we have together talking about our positioning and then some. So how are we positioned with respect to multi-asset portfolios? At a high level, we remain pretty constructive. We are overweight equities when compared to fixed income, but we're not taking on excessive tracking error. So a typical 60-40 portfolio is going to look more like maybe 63-37 or so. We're not comfortable taking on a ton of tracking error today simply because of the uncertainty out there. We do think that there are pockets of opportunity, and I'll get into those in a bit. But broadly speaking, we don't think now is the time to begin or continue piling on risk onto the portfolios. So we're overweight equities. That's supported by a pretty good earnings backdrop, as we just discussed. Within equities or level one equities, we continue to favor U.S. large caps. This is where I think you have more earnings durability. You got stronger balance sheets, and we've been leaning in to broader participation as well within equities. This to us is to help us manage concentration risk. If you look at the Mag 7 today, the Mag 7 comprises what, 35-40% of the S&P 500. Super concentrated at the moment. I think it's over 50% of the NASDAQ 100. So we would support broadening out the exposure even within large caps to capture some on the bottom end of the cap spectrum. We're also overweight emerging markets. And I think this is where valuations are more attractive. You get diversification benefits. You get the dollar did spike for a very brief period of time. But as the dollar has continued to weaken, that's supported flows into emerging markets. And then you've got individual country exposures that have been really beneficial to portfolios. I'm looking at Korea in particular. Korean exports have remained unbelievably strong year to date as well as last year. We expect that to continue. I'm talking about advanced manufacturing, auto parts, chips, et cetera. So we continue to like emerging markets. We think it's a good area to have a slight overweight in our portfolios. Small caps, we're neutral, but we are still constructive. I'd emphasize selectivity here. They've actually been additive to our portfolio performance this year. I think this is largely driven by just generally improving breadth. But then I think there's also some valuations catch up going on here after a long stretch of underperformance for this part of the cap spectrum. That said, they are, as you probably know, more sensitive to rates and to financing conditions. So we're being thoughtful about how we get that exposure. To put a finer point on what I mean by emphasizing selectivity, I think this is an area in your portfolio that if you have the ability to put in an active manager and an active ETF, you want to do so. 40-45% of the Russell 2000 is broadly unprofitable. We don't want to get exposure to that. So we're utilizing managers that employ filters for profitability and valuation to help us get some smart exposure to the small cap universe. Okay, so that's equities. Let's talk about fixed income quickly. We're underweight overall. Yields are more attractive today than they have been, but again, rate volatility, tight spreads, limited upside. Just the risk return isn't there from an equity fixed income perspective. Within fixed income, we're focused on quality. You look at our positioning here, we're neutral, investment grade, neutral, international developed, underweight high yield. As I mentioned before, spreads remain really, really tight and high yield. And so, we prefer to be up in quality within fixed income. So that's our positioning. As I want to emphasize before, or I think it's worth emphasizing again, we're keeping our tracking error relatively tight to benchmarks, just given the uncertainty on the macro scale. It's not really about making really large directional bets per se, but rather what you'll see is it's about making these incremental tilts where I think they can pay off in this broadly diversified framework. Constructive fundamentals, the backdrop I think requires a lot more balance and a lot more discipline. Okay, let's get a little bit more granular here. Drill down a little bit into U.S. sector positioning. Just looking at the clock. This is where I think selectivity really shows up. What you see here is the sectors that we like today in our portfolios. These are primarily related to the U.S. large cap space, technology, consumer discretionary, utilities. It should be utility/industrials, but then healthcare as well. What we're running here is effectively a barbell strategy. On the growth side, we like the technology or IT. Earnings are strong. Margins are higher. Margins are close to double in IT, what you see for the broader S&P 500. You've got investment that's tied to AI. Digital infrastructure is continuing to support the space. Valuations have actually come in a little bit. They didn't move at all in 2025, right? So earnings have continued to grow. Valuations haven't moved up meaningfully as a result. You've seen in some areas multiple compression, particularly on the software side, which we can get into if anyone has questions around that. But generally speaking, for the broader space, we're still seeing really strong fundamentals, and I think that's the setup is pretty good. Now, there is meaningful dispersion. Um, but again, if I go back to valuation, an interesting tidbit here, the forward price to earnings ratio on NVIDIA is lower than that of Walmart. I think NVIDIA is trading in the mid 20s right now in terms of multiples forward looking, that is. Walmart's sitting in the mid 40s, right? So yes, these are high growth names. They're not necessarily, not all of them are necessarily more expensive. If you're looking at just price earnings in some of the other areas of the market out there, continuing to see margin expansion, and that's a good thing. Okay, enough about tech. We like it. We're positioned that way in our portfolios. Consumer discretionary. So we're constructive, we're selective. Consumer is still holding up, as we mentioned before. This is where higher energy prices are showing up. So this is an area that we've been constructive on for a while, but we are watching. Typically, what happens in discretionary is this: when you see consumer confidence, when you see consumer sentiment from UMich crater the way it has, the forward returns on a 6-month and 12-month basis for consumer discretionary tend to be better than they are than the broader market. Why? Because things tend to overextend to the downside. So this is an area that we like. It's not a major overweight in our portfolios, but it's one where we, where we've allocated a little bit more. Other side of the barbell, the defensive side, utilities and healthcare. Utilities, we're playing it. It's a combination of structural demand, particularly from the electrification, data center growth. There is some rate sensitivity here, but we do like this area. We've liked it for some time, I think since September of 2025. And then last but not least, healthcare. This one's been kind of an odd one. We put this trade on last year. It's meant to be a defensive position, but it sure hasn't acted like one, particularly during the drawdown that we saw in early March. We did like valuations. We like the defensiveness of the earnings, ongoing innovation in the space. It just hasn't played through, but it is meant to be that opposite side of the barbell. So when you kind of take a step back and you look at the idea here between these barbell approach, lean into growth where the fundamentals are strong while maintaining some exposure to defensives to help manage that volatility. Now, one thing that we spend a lot of time on is not just what we invest in, but it's also how we express those views. And I think here what we've listed is a good example of it. We've listed a number of different themes, some popular themes out there: US consumer, cyclical recovery, the AI build out, geopolitical hedge. And then what we've listed is 2 different ways of playing this: your standard exposure, and then call it your risk aware exposure. And the point of this slide is meant to show that there are multiple ways of playing the same theme. Let's utilize AI because I think it's a good example of that. The most straightforward way to play AI is to get exposure through a concentrated position or concentrated positions in a handful of really well-known names. Some of these have obviously done really well. But what we try to do is to broaden the exposure there. So instead of focusing on the most obvious beneficiaries, we also look to the second and third order effects here, things like semiconductors, infrastructure, data centers, the broader AI build out that will also benefit, but can do so in a risk-aware way, right? This helps to reduce concentration exposure, and it helps to give exposure in the same theme in a more diversified way. So again, managing volatility, implementing an allocation to the same exact theme, just in a different way, right? So we're participating, but we're doing so in a more balanced and a more in a restrained way, so to speak. All right, let's spend a minute talking about private credit. I want to spend a minute here before we wrap up because it's been getting a lot of attention right now and for the better part of the last couple of weeks, couple of months in general. Now, at a high level, this is a large and let's call it still growing part of the broader fixed income asset class. It's roughly 2 to 4 trillion in terms of AUM. Put that in perspective, I think the broader fixed income market, govies, publicly syndicated loans, et cetera, are sitting at maybe 130 trillion, 140 trillion. So this isn't that large a part of it, but it's large enough. And it's been an important part of mid-market financing, mid-market lending, particularly as large institutions, large banks have retrenched from the space. It started in '08 and accelerated after that. And so it's growing in importance to the market. It's growing in importance to investors. And broadly speaking, I think the fundamentals are still holding up. despite all of the headlines. And this is after speaking to a number of different managers in the space who are at the ground level here. Yes, default rates are rising. They're rising from really low levels of 2% to a much more normalized 5%. Put this in perspective, during the GFC, they were sitting at 8% and above. Now that's elevated to a few years ago, but it's not that far out of line with long-term averages. Now, that said, there are things that are happening beneath the surface that I think are worth watching. We're seeing, first and foremost, much more activity in the way of, let's call it, amend and extend. This is where loans are being restructured rather than formally defaulted. We actually saw this coming out of COVID in the commercial real estate space in 2022, 2023. That's why we didn't quite see that same washout that everybody was expected. We're beginning to see that here in the direct lending space as well. And we're also seeing an increase in payment in kind. This is where borrowers are deferring interest payments rather than paying cash. Now, these things can be helpful in the short term, but it could also be a sign of bad hygiene. It can also be a signal that some of these borrowers are under more pressure than initially thought. We're also seeing, more stress on the semi-liquid side, particularly as redemptions begin to pick up. And I think this is the real key point here. It's a vehicle structure that's being tested as much as the underlying credit quality. And private credit by nature is less liquid than publicly traded debt, but you pair that with a more frequent liquidity features, and I think this is where a lot of the tension is arising. The other part to mention here is that we're also seeing concentration in a particular factor, and that being software. Right, so we've gotten the inbound, we've gotten the question: how much exposure do these managers in general have to the software industry? How much does it comprise of portfolios? 20 to 25%, and in some cases even higher, much higher. So it's something to be aware of. Now, you take a kind of step back. To me, this is becoming an increasingly selection-driven market where structure, underwriting discipline, manager quality is going to matter much more than it did a few years ago, where deal flow is plenty and managers were beginning to make those types of deals, again, as larger banks, larger institutions started to retrench. Now, for those investors who are currently gated, currently facing redemption limits, what we would expect is a gradual normalization over time, rather than, let's say, a sudden release of liquidity. Again, this is what we saw in 2022 with the non-traded REITs of the world. I think managers in the space are going to continue balancing redemptions with stability. Right, those gates are there intentionally to protect the integrity of the vehicle. It's to protect the longer-term investors. So liquidity is probably going to improve, but it's going to do so in a measured way. So just something to keep in mind here. Okay, wrapping up quickly, just looking at the time, we're about 35 past. Let's spend a minute, or I want to spend a minute talking about diversification. What is a well-diversified portfolio? What does it mean? The chart on the right is a correlation matrix of a multi-asset portfolio. You'll see three colors: reds, whites, and greens. Reds refer to correlations, which measure the movement between two securities or asset classes. Reds are higher correlations, whites are low to no correlation, greens are inverse correlation. And what you're seeing here is a snapshot of how these asset classes, these solutions, behave relative to each other. The key takeaway here is pretty simple. In a well-diversified portfolio, you want to see a mix of red, white, and green, meaning some assets move together so you can get that exposure to risk assets. Some assets move differently, and some move in opposite directions. This is what ultimately helps to smooth out the ride, smooth out the experience. Now, as we've talked about earlier on in the call here, there have been periods, particularly one that we went through, especially that are more inflation-driven than growth-driven, where correlations can move higher. We call it correlations moving to one, and things start to look a lot more red across the board. And this is where diversification can feel less effective over the short run. Longer term, these things tend to evolve. They tend to even out. But short term, it can be a little bit different. Now, something that we've also been spending more time on is on the left here, looking beyond the standard menu of long-only stocks, long-only bonds, ETFs, mutual funds, SMAs. And this is to help refine the portfolios around the edges. So things like direct indexing, which can help customization, which can help after-tax returns, and increase efficiency. Things like concentrated stock solutions, given where markets have evolved over the course of the last 10 years, you may have concentrated solutions that need to be hedged. Helping to manage the single stock risk can also help with respect to exposures. Defined outcome strategies. These are strategies that provide very clear risk and return parameters, upside participation, downside limitations, and then last but not least, targeting individual themes. Themes like, say, the AI build out, nuclear energy, any number of digital assets, things of that nature, giving exposure to these individual themes that are away from the broader markets. All four of these solutions on the left-hand side can help you refine your portfolio such that you can introduce, or they can introduce, other elements of lower correlated assets into the portfolio. So the goal with these things here isn't just high returns. It's improving how the portfolio behaves over time, as well as across different environments. So if that's something that's important to you, I'd encourage you all to speak to your advisors about that. Okay, I'm going to wrap up here. What would make us change our minds about some of these, about some of our views? Three things that we're watching here. First is energy. If oil moves higher, oil stays higher, not just a short-term spike. It increases the risk that inflation becomes persistent. Second is financial conditions, whether through rates, spreads, or liquidity, whether tightening accelerates. This is where I think it can begin to impact growth more meaningfully. And then third is fundamentals. If we begin to see fundamentals deteriorate in earnings in the labor market and the consumer, that would be a more meaningful signal for us. Now, until we see that, though, I think to us, this is looking more like a volatility or higher volatility rather than a structural shift. We haven't made any changes in our portfolio positioning as a result of the volatility since the start of the escalation. And like I said, until we see one of these three or a combination, I don't think we will either. So where do we go from here? Perspective is pretty straightforward. Geopolitical shocks, they're certainly disruptive in the moment. They tend to be short-lived for the markets. Over the long term, markets tend to revert to fundamentals. At the same time, we're watching a few things, as I just mentioned, oil, because that drives inflation, because that drives policy, and then credit and earnings, because that tells us how healthy the system really is. So we're paying attention, but we're also keeping things into perspective. And with that, I'm going to leave you with a simple takeaway here at the bottom. Stay invested, stay disciplined, and focus on the fundamentals, not the noise. Thanks again for taking the time to join us today. We really appreciate it. I really appreciate it. And with that, let's take the remaining 6 minutes that we have. So I'm just looking up the clock to open it up for any questions.
Yeah, Anshul, really appreciate the perspective and detail here. A few questions have been added to the chat, so we'll jump in. And then for anyone on the call, feel free to use that Q&A section at the bottom of the screen to add any questions. So for the first one, what is your year-end target for the S&P 500?
Oh, yeah, okay. So this is a good one. S&P right now is trading forward earnings at right around 21 or so. So there are a couple of ways of going about this. Let me get to the punchline. The punchline is between 7,200 and 7,800. It's a pretty wide band. But we're sitting at what, maybe 7,150? I forget where we are today. But let's say that we apply that same type of multiple. Now, earnings estimates for forward calendar year 2027 are sitting at, I think, 345 or so in terms of operating earnings for the S&P 500. So we do a little bit of math here. We apply, let's assume no multiple expansion whatsoever. That gets us to right around 7,500, all things equal, by the end of the year, if those estimates stay where they are with respect to earnings. We can also kind of dial it up and dial it down, right? So we don't actually have to believe that the S&P is going to stay forward earnings at a 21 multiple. We can say what happens if multiples compress down to 19 or 20. What happens if they increase to 22? Kind of gets us to between 7,200 and 7,800 or so, depending upon a couple of different factors.
Great, thank you. Next one is, how do you think about allocating to alternatives, specifically middle market private equity?
Yeah, it's an important part of a component for those who, sorry, it's an important component of a portfolio for those who have the ability to do so. Mid-market private equity in particular is, let's call it, less efficient than some of the larger areas of private equity or the large cap areas. It's an area that's more niche in particular. What I would suggest is that if that's an area that you're looking to invest in right now, find a manager that's been an operator in that space in particular. It requires a lot more detail, not a lot more detail, more detail in a couple of different ways than say large buyout or those types of strategies at the larger end of the cap spectrum.
Next one is, international markets have done exceptionally well compared to domestic markets over the past 5 to 6 quarters. Are you optimistic that international continues to outperform domestic markets, or do you see the tide shifting back to domestic outperformance?
Yeah, I mean, if you look at our positioning right now, we do continue to like emerging markets. International developed, we're at a neutral. And let me just refine what that means. Neutral is neutral to strategic asset to strategic weight. So we still have a weight to both international developed as well as emerging markets in our portfolios. We like emerging markets slightly more, so we're allocating just a bit more. To answer the question more directly, yes, last 5 quarters in particular have been great for international developed as well as EM. EM we continue to like for a couple of reasons. Dollar weakness that leads to flows, but then also specific country exposures I think are going to continue to power the index at a high level. International developed, you can make the case that Europe right now, where they're sitting, that is beginning to look a little bit more worrisome, particularly because of the energy shock. And it remains to be seen, or the thing that we're watching is how persistent, how long this disruption is going to be. I think that could materially affect what's going on over in Europe. The ECB in particular and the BOE are both set to raise rates. That's to battle inflation over there. So we'll see exactly what transpires. But we're neutral, developed markets, and we like emerging markets within our portfolios.
Great, thank you. And then, so we do have time for one more question. So again, appreciate everyone for submitting. Last question: what do you expect the Fed to do in the coming months with Warsh coming in?
Uh, um, Probably not a whole heck of a lot. What I mean by that is there's been a couple of things that have come out that we know about Kevin Warsh. One, he doesn't like the fact that the Fed has a really large balance sheet. So he's not going to expand the balance sheet. That's one. I don't think that the Fed has that much in the way of flexibility to drop rates. But here's the conundrum. We know that the economy needs to run, kind of hot. So one way to do that is obviously to ease financial conditions. There are a couple of different ways that the Fed can do it. They can get creative about that, letting certain parts of their balance sheet roll off at a faster pace than where they're buying along the curve. But really, if you've been paying attention, what they really want, what the administration wants to do overall, they want to help stimulate the economy, obviously. And one way to do that is to address the long end of the curve. So they could take measures there to address that long end, which would flow into mortgage rates, and help stimulate the economy that way, rather than explicitly turning around and dropping rates at the short end. I'm kind of with consensus. Maybe I'm a little bit more dovish than consensus. 20% chance of one rate cut by the end of the year. I'll go a little bit higher than that. I think the chances are a little bit higher that they will actually implement one rate cut at least.
Great, thank you. So yeah, that's all the time we have for questions. Anshul, I'll turn it back to you so we can close this out.
Yeah, wonderful. First things first, thank you to everybody who took the time to dial in today. We know that you're all busy. We know that this took time away from your practices, from what you were doing, and we appreciate it. If there were any outstanding questions that we didn't get a chance to answer, please, by all means, send them to your advisor, and your advisor will send them up to us, escalate up to us, and we'll make sure to get every single one of those answered. Thanks again for your time. We do these on a quarterly basis, and so we will absolutely, we hope to see you next quarter. And with that, Connor, I think I'll end it. I hope everyone here has a wonderful rest of the day, and we will see you next quarter.